Are you getting a lot of emails from your employer about making elections or changing investment options to next year's 401k? Navigating those end-of-year questions is the topic for this morning's U.S. Bank Economic 360. Mindy McLaughlin, Senior Vice President and Senior Portfolio Manager for U.S. Bank, joins Business Watch producer Kelly Leon in the studio. Mindy and Kelly.
Thanks, Peg. Hi, Mindy. Thanks for being here.
Great to be here.
So recommendations, we need recommendations. How much should we contribute to our 401k?
Sure. 401ks are an awesome investment vehicle. One of the few that we have, I think, that really makes a lot of sense. And the IRS just changed the amounts for next year. So for 2015, individuals can contribute up to $18,000 of their salaries into their 401k. I know that sounds like a big number for a lot of people, and sometimes that's difficult to do, but at the very least, I always suggest that individuals at least contribute whatever your company matches. A lot of companies are generous and will match you up to 4 or 5% of your base salary. So you should at least try to do that, but if you can do the full 18, it's a great way to do it pre-tax.
Yeah. What about, does age matter? What if you're over age 50?
It does. It does. Yeah, the 18,000 is for individuals who are under age 50.
Oh, okay.
And if you turn 50 or are older, the IRS kind of recognizes that it's tough to save when you're younger, and so they have what they call catch-up contributions. And so they permit larger amounts. It's $24,000 for next year that you can defer into your 401k. And, you know, again, that's a big number too, but really with income tax rates, you know, having risen over the recent past, if you look at kind of the net after tax, you'd be surprised it doesn't really impact the bottom line quite as much.
Yeah.
So,
well, that's good advice. And then once you make that contribution, what about investing? What kind of funds do you recommend?
Sure. Most companies today have outsourced that function. You know, they have plan administrators and companies that handle the investments. And in my experience, I've seen a pretty limited selection that employees get to choose from when they do their investments. Usually what you see is a stable value fund, which is like a money market fund. You'll see a bond fund, probably a large company domestic stock fund, maybe an international fund. And if you're lucky, you'll get the choice of a real estate fund, which did really well this year, or perhaps a small company fund, which tends to be more growth oriented. But the big thing that I've seen come about in the recent past is they have what they call target retirement funds now, target date funds. So for example, if you're going to retire in the next 5 years, you might want to look at what's called a Target 2020 fund. These are funds that are kind of pre-mixed and managed for you. So for somebody that's not really that interested in it, this might be a good option. And the one thing, though, that I would caution you is certainly if you're going to retire in the near future, some of those target date funds will be pretty heavy in bonds. And I know we've talked about this on the show before. You know, bond funds never mature, and so if rates rise, which we are expecting, you could suffer some principal loss. So I always suggest that whenever a company has like their contractor come in to talk about 401ks, that the employees go to those, you know, make sure you talk to somebody or go to the website and call so that you really know what you're invested in, and they can help you, you know, guide that a little bit further. But don't miss that match at the very least. That so many people don't do it, and that's free money. You don't want to lose
another thing for us to think about too at the end of the year. With
I know,
so much
but you got to do it.
But you got to do it. Great advice. Have a wonderful Christmas.
Thanks, you too.
Thank you to you and to U.S. Bank for all you do for us here at the show and the community.
Great. Thanks.
Peg, back to you.